Big question, lots of debate, and it is, do we pay taxes now or do we defer taxes and pay later? And I have heard opinions from CPAs and attorneys and financial advisors, and what I've determined is that most people, when they give an opinion, even individual investors have an opinion on this, and the opinion is simplistic. And by that specifically, I mean we're making a couple of assumptions that are not accurate and not fully encompassing of everything that should be considered. I've sat down in several meetings with CPAs or individual investors, or I've watched YouTube strategies on this, and too often I've seen just a massive myriad of incompetence and bad advice. What I'm going to do today is I'm going to show you some charts that eliminate the guesswork. We don't have to wonder if we should be deferring taxes or not. You see, the central issue is not what some CPAs may say or some individual investors or someone on TV may say that, well, look, if I'm going to be in a higher tax bracket in the future, I should just pay the taxes now because I'm going to be in a higher bracket in the future. I should not defer. And I see that, and I've even seen people do PowerPoint presentations where they show here's today, here's deferring, here's not deferring, and there is actually a massive flaw in what they're illustrating. And it's not taking into account vital information, so it's very misinforming, and I think it's causing a lot of people to make really bad decisions with whether or not they should defer taxes. So some big issues here. And the other thing is, it doesn't always come down to taxes on tax deferment. Usually a tax deferred vehicle offers increased credit, decreased liquidity, and other aspects to whether or not you should defer. But if we're just looking at tax deferment, don't believe what maybe your CPA or someone else told you or something that you heard, that it just comes down to if you're going to be in a higher bracket in the future. That is not what it comes down to. It does not come down to if your kids are going to be in a higher bracket and this is money that you're going to be passing to them anyway. The central issues are these. Is it worth it for me to pay taxes now, knowing that tax brackets may be higher in the future, or am I better off to defer the taxes and pay in the future? And what we have to look at is a couple of main criteria. We have to make assumptions because we don't know all of the variables here, but we have to make some assumptions on what our rate of return is going to be, when we're going to access the money again, is it 10 years, 30 years from now? And then we have to make some assumptions, and this is one of the hard parts, on where tax brackets will be on that investment. So for example, if I'm buying an investment today at a 30% tax bracket and I think my bracket's going to be 50% in the future, most everybody I've ever talked to would say, absolutely, pay the taxes now, don't defer, because otherwise you'll be paying taxes in the 50% tax bracket. Well, we're going to look at an illustration and see if that bears out to be true. You see, Rockefeller said that the key to wealth in this country is to not pay taxes on money that you're not using for current consumption. Let's find out if that is accurate. Take a look. Okay, so again, our three criteria for determining whether or not we want to pay taxes now or hold off and pay taxes in the future, defer taxes. We need to determine what we anticipate the expected return will be, how many years over here on the left we anticipate we're going to be holding the investment, and then what we anticipate the future tax bracket will be relative to current tax bracket. So for example, current tax bracket today for capital gains, we're talking about investment dollars here, 15% for most taxpayers. If you're making $1 million, 15%. When you get down to a lower income, it could be as low as 5%. So let's assume that we're going to average 8% return in our investment. And we're going to hold the investment for 20 years. The tax bracket for your capital gain rate would need to go to 45%, a factor of 3. It would need to triple for you to not want to defer taxes. So you look at it and say, well, wait a minute, I should just pay taxes now on my capital gain. It's at 15%. Well, wait a second. That's not true. This is what we call the tax hurdle factor. 8% return times 20 years. You look over here. If the capital gain rate, you take this number, 30%, plus the current rate, 45.1% total, is what the capital gain rate would need to be 20 years from now for you to look back and say, boy, I should not have deferred my taxes. So as you can see here, the higher the return and the longer the time period and holding the asset, the more compelling it becomes to defer taxes. If you're looking at a 4% return and you're only going to hold the investment for 5 years, you have to ask yourself, our tax bracket's going to be higher than 17.7% 5 years from now, and if I think they are, then I ought to just pay the taxes now. But as you can see, it usually is very compelling to defer the taxes as much as possible, even when capital gain rates are low. Now let's do something we call in microeconomics. Not I was asleep for most of the class, but I do remember walking the numbers, and I want to go through an example of a taxable investment. This isn't capital gain taxes now. This is income taxes. This is talking about your income in the future. Again, the argument is just pay taxes now. Capital gain rates are low, income rates are low. Well, wait a minute. Let's look at the actual numbers because calculators never lie. So taxable investment, I invest $100,000. My bracket today is 30%. And let's say, I just think the country's spending all this money, they're going to tax the wealthy, and I'm going to be taxed at 50 cents on the dollar in 10 years. So I had to just pay taxes now. Well, let's compare this. Obviously, $100,000 invested makes a 10% return, let's say, for illustration. I'm going to end up with $107,000 at the end of year 1. At the end of year 10, I'm going to have $174,000 by paying taxes along the way every year. In my tax-deferred investment, at the end of year 1, obviously 10% return, I have $110,000. At the end of year 10, I have $259,000. But wait a minute, I have to pay my taxes now, right? On my gains, I have to pay capital or income taxes. I still have an extra $85,000. Now, let's compare. I have to take the money out and pay taxes. I'm still $5,600 ahead, even in the 50% tax bracket. I still was better off paying taxes in 10 years at 50% than paying them today at 30%. But that's not really the most important thing we need to look at in this situation, you see, because most people don't take their money out of qualified plans, out of IRAs and tax-deferred investments in one lump sum. Some people pass them on to their kids, but for most people, you harvest your assets via an income stream. You need a monthly income. So let's project this thing out 10 years and let's say, okay, if I'm taking income off of this bucket of money that I left in a taxable investment, I'm taking $8,700 a year at a 10% return rate net, versus my net income on the tax-deferred investment, $12,900 a year. 50% increase in income because I deferred taxes for 10 years. So all of a sudden it became far more important to know from a tax standpoint whether or not I should defer my taxes or pay now than even perhaps what my return was in the end. So as you can see from the charts that we looked at, and you can go back and pause this thing and see whether or not you should be deferring taxes just based upon it being a tax issue. But keep in mind, there's other issues involved. But now we can at least eliminate a vast majority of the guesswork and make a decision based upon being empowered with the right knowledge on deferring taxes. Remember, in most cases, deferring taxes just is simply the right move.